Hey, how you guys all doing? Today is Saturday, May 29th, maybe May 30th. Anyways, we're back here. We're a day early because of scheduling and I'm in another construction project. So today worked because it's going to rain today. I'm not going to be able to do a lot of work and I got to work tomorrow. But today we're talking about a couple of interesting things. One is there's a giant stock surge going on in the middle or the beginning of a depression. Doesn't make sense. We're going to talk all about that. Then we're going to get into short-term rental updates, especially with Airbnb. What's going on with these not relaxations, but these relaxing policies of traveling, opening up economies again. What's going on? What's going to happen? What's going on in my own portfolio of short-term rentals? And then we're going to get into talking about my $25,000 gamble against the U.S. market or the U.S. economy, however you want to say that. But I'm going to show you my portfolio, what I'm going to do with $25,000, and maybe what you can do if you have some extra money laying around to see if you can make some money off the depression. Now, and then lastly, I've got a lot of messages about Facebook and wanting to value it and people thinking, especially with their latest update with Instagram. Sorry, I'm all over the place right now. But we're going to be talking about their latest news about Instagram. I'm going to talk about that. So I'm going to write that down right here. And we're going to see if we can value Facebook. And now when we do valuations, I take you through the process as if you are an MBA student or somebody who's even working in a company doing a merger and acquisition when you value private companies, right? You look at their financials, you look at their leadership, and then you apply a valuation on. There's actually some good ways of truly valuing a company. And when you guys hear this a lot, if you guys are listening to the news, even YouTube or anywhere else where they're talking about how the market is so overvalued, that's what I'm doing here. And I haven't seen these companies before, so we will pull up Facebook here in a little bit and we'll go through the financials. I'm not even sure we're going to be able to value it because they have to have profit to be valued. And I'm not sure if they've been profitable or not. And when I say profit, I mean cash flow. So we're going to talk about that. And then towards the end, I've got a couple of questions from Instagram and then also my comment section. And then anybody else who has questions in the chat, go ahead and feel free to leave a comment. And let's see if this is working real quick, because this has not been working for me the last couple weeks. You all hear and see. Let's see if that goes through. Make sure this is public. It's good. All right, so I hope that worked. Sorry I have to do this every single stream because this thing's always messed up. Hang tight, I'm going to refresh it super fast and then I'll jump right back in. Let's see if this works. It's so strange I have to refresh it. Okay. So I think it's working now. Okay. Let's jump into let's talk about the short-term rentals first, and then we'll get into the surge in the stock market. So short-term rentals, as you guys know, or maybe you don't know, is that Airbnb went out and raised $2 billion in short-term, basically like a line of credit in cash. And how they did that is they went to a bunch of investment bankers, or not investment bankers, but investment firms to raise this $2 billion. And actually, they were able to raise money fairly quickly. And this happened about maybe 2-3 weeks ago during that whole layoff period where they laid off like 25% of their staff or 1,900 employees. So the good news is that they were able to get the $2 billion. And that $2 billion was to handle their cash burn. And what cash burn is we all have it, is if you make no income or little income, is how much money do you have in your bank account to pay off your expenses each month. And so a lot of times we talk about monthly cash burn. So Disney, for example, I estimated and calculated that their cash burn from having all their parks closed during the COVID-19 thing it was around $20 to $30 million ish a day. And so it's a lot of money to burn through. Airbnb has the same problem because obviously they have staff, they have employees, they have rent, they have marketing expenses, so on and so forth. That's why you saw them lay off 1,900 employees, and that's why they pulled out a loan for $2 billion. Now, in terms as countries and economies start opening up, we should see Airbnb start doing better in terms of getting bookings. They have put a lot of effort into virtual experiences, which I haven't personally done. It sounds a little bit silly, but who knows? Maybe it's the future here. We've been doing Zoom a lot. I saw like one business started to flourish where they do virtual tours of their farm, so you get to see like their chickens, their goats, their llamas, and that type of stuff. So who knows? Maybe it works out. But in terms of rentals, my portfolio has been going really, really well. It's a lot of locals and a lot of folks that are just basically traveling around the state inside this our little bubble. So we don't have a lot of international or a lot of folks from other parts of the country flying in, and it has cost us more money because we've always done a very good job cleaning, but we have to take disinfecting to a whole nother level now. Using ozone machines, we use a lot of bleach and disinfectants around door handles, faucet handles, that type of stuff in the kitchen and bathroom, where we were wiping it down before, but we weren't necessarily disinfecting every major surface. Now we are, and we use the ozone machine. But one thing that I want to warn you guys, or give you guys an update on, that I made a mistake on, is I didn't get lazy. It was just that we were getting so busy, and with more before this whole COVID-19 thing happened, we had enough properties and enough bookings and enough guests where I couldn't do my normal, what I've said in all my other videos, where I screen the tenants fully. And when I screen tenants, it's that we have several layers. Obviously, in the description of the Airbnb, we have a lot of, not stipulations, but we have certain rules, right? No partying, no, you can't have like 15 cars at the house, that type of stuff, right? And then a lot of times what I would do is I have a rental agreement, and I would call and talk over the house rules with the guests. And I used to do this, I did that for like 10 years, where I talked to everybody. But because we've been so busy, and I've been busy in other parts of my life, I stopped doing that. I still did a message. I text them, I sent them rental agreement, but I didn't do the phone call. And this was the first time where I got in a lot of trouble for it, in the sense that I didn't talk to somebody who had 0 reviews that was newer. We had them send a rental agreement, but they came to one of our properties, threw a huge party, cigarettes, marijuana all over the house, all over the outside of the house, and they got us in trouble with the local, not just the local authorities, but also the neighborhood, to the point where we have to stop renting short term because so many of our neighbors complained from that. It was a 6-day stay, and pretty much they partied every single day, and we didn't know about it until they left. And not only did they completely close the mattress protector all the way through the mattress, and it just completely stained. Huge stains all over the carpet where professionally we couldn't even get out some of the stains. House smelled like smoke. Basically turned into a party house. And because of that one thing, what I call a silver bullet, or in business you call it silver bullet, is like things can go so well for so long, and we've had that property for almost 2 years now, and one guest ruined it for everyone. Ruined it for us, ruined for future guests, and now we are looking at other options because I didn't go through with a standard that I held myself to for all properties. So it's a good lesson to learn, and I want to pass that on to you. Is be careful if you ever decide to go in short-term or even long-term rental, or if you decide to go into rental investment, make sure you screen your tenants properly. And I mean fully screen, get to know them. Even if it takes a 2-minute phone call, or if you're doing a longer term, I always meet with them for about 30 minutes to an hour while I'll give them a tour, because you want to know who's entering your home. Because that one time that you don't do it, use me for example, and they do something, even though they sign an agreement, it's like, yeah, we'll do that, we'll pay you, whatever, and they don't, and they go above and beyond and do something even worse, like damaging your property or upsetting your neighbors, it can ruin your entire rental business and cost you a lot of money. And so this will cost us a lot of potential revenue, but it's a good lesson learned. All right, let's check this out. What up, Jen? Mark, what's going on? Welcome in. I got Alibaba on my list. We're going to talk about that here in a little bit. Jen A's in here. Where's the other Jen? Let's see. Kai, 2001, we had 9/11, Apple, and Amazon were... I'm going to answer questions real fast because Mark's in here. And I know, Mark, you asked really good questions in the comment section. All right, so yes, 2001 we had 9/11 and Apple. Manuel, what's going on? Apple and Amazon were dirt cheap. In 2009 we had Tesla and Netflix. Now it's 2020. What is the next stock trend for the next decade? Airbnb, Baba. Dude, that's a great question. I'm always learning what's going on. That's a great question, Mark. I would have to look into that right now. Knee-jerk reaction. If we're looking at growth, I'm thinking Spotify. And I would have to, but Spotify is already so crazy not overvalued, but it's already at $100. But I could easily see Spotify going into the thousands in 10 years. I could see it being in like Chipotle, Amazon levels if they take over the podcast scene and become the standard for music. If you think about it, we are surrounded by music in almost every facet. And if they play into that and they lean into it, I could easily see getting 10 to 15x. Outside of Spotify, man, I don't know. Facebook is making a lot of moves, but again, they're trading at $200. If you're looking at something that's that's undervalued and out of the radar, that's trading under $20, man, I don't know. I don't specialize in growth stocks. I would have to look into it. If you have any great ideas or any suggestions, I would be more than happy to look into it. I would think of something. Maybe a sleeper as in like PayPal if they get into Venmo or somebody starts getting into digital currency and becomes more mainstream. But right off the bat, I can't think. But I think Spotify is the one that's really on my radar right now because they just signed that Joe Rogan exclusive. And they kind of showed their hands that they're going all in on podcasting. And I don't know if you guys know the numbers of podcasting, but it is a huge business. Think about YouTube, except for podcasting. YouTube is fantastic, obviously, because I'm on it. You're watching right now. Is that we can watch it, right? When we need to learn something, I need to figure out how to do a certain, I'm doing a huge remodel siding project right now. But if I'm like, hey, how do I side around a hose bib that's already installed, and I don't want to have to cut off the water line? What do? I can go on YouTube. But with podcasting, I don't have my earbuds on. I always have it on my phone, and I have a ton of podcasts that are just always cycling through, always listening to it when I'm working or cleaning the house or whatever it is I'm doing. I don't have to sit down on a computer or watch it like YouTube. So I don't know. That's a great question. We'll follow up on that. If you have some ideas, let me know. I'll look into the companies with you. What's going on? I cannot begin to pronounce your name from India. But hello from India, or hello from the US to India. Thanks for jumping in. SQ, what's SQ? Is that Square? What is that always learning? Let me look it up right now. I'm going so off topic. Yeah, it's Square. They're at $81. Square could do it. I heard Square take a huge, they made a big move fairly recently. I don't know what it was. I'd have to look into that. Square could do it. I remember Square was pretty big. I don't know if you guys know this, but I did do, I was a partner or an investor in a food cart, and I remember we used Square a lot. Square has a lot of competition with PayPal, and now like Apple. The problem with the currency or the transaction market is that there's a lot of competitors, right? And you've got competitors includes Google, Apple, and maybe Microsoft. Those are competitors I don't like. And I really like going back to what Mark was saying. If you think back to Netflix and Tesla, or even before that, you think about Apple and Amazon, they were disruptors of their own markets. And so right now we're trying to think of who's a disruptor of the market. And I keep going back to Spotify because they're looking at disrupting the market that's owned basically by Apple and Android. And they're going to shake it all up and they're going to do their own thing with Spotify. Or their version of Spotify. So, but anyways, let's get back. We'll touch base. I'm gonna write a note to go back to potential growth stocks later. Okay. So that's the Airbnb update. Short-term rental is they've got $2 billion in cash. They have a line of credit. I think Airbnb is going to do just fine. They're going to have to adapt. And as long as they can ride out this storm, they'll be fine. And like I said, we were nervous at first. We've definitely seen a slowing down in the Airbnb market. And I think it's going to hurt a lot of folks who are just kind of putting together a random home or renting out really like kind of like middle line or even low line apartments and then renting them out through Airbnb. I think those folks will get hit the hardest. I think folks who really did their due diligence and have really nice homes that are unique and focused on the customers and guests, cleanliness, and have like over a 4.9 star rating. I think those folks, if they didn't over leverage, they're going to do just fine. Now, can the company of Airbnb itself survive off just those customers and hosts? We'll have to see. The tough thing with Airbnb is that they're not a public company, and I bet you they wish they had gone public just last year when they were supposed to, because we don't get to see their financials. We only see what they announce because they're private. But from what my knee-jerk reaction, $2 billion in cash, them laying off 1,900 employees, and they're restricting a lot of costs and expenses now. I think that they'll be able to survive the next year to 2 years. And I think that's enough time for us to come back and for Airbnb to at least break even and hopefully move forward from there. So it's definitely a huge hit, but I don't think they're out of the game. And I think as long as we, as human beings, we want to travel, we want a vacation, we got corporate events, we got all this stuff, whether it's 2 years from now, 5 years from now, there will be a need for something to compete with hotels. People would much rather, you guys can't see the view, but would rather come out and stay in the country somewhere than in the middle of the city. If they're on a honeymoon or road tripping with a friend or a partner. So I think it's going to be there for a long while, as long as human beings like to travel. All right, moving into the second thing. How much longer until the depression hits? This is the big question, and it's something that is obviously something in my mind all the time because we're all here trying to figure out, all right, how do we take a bad situation and make the best of it, right? Making lemonade out of lemons. And so it's tough to time anything. The thing is that's very apparent now is that we are in a recession, or we were at least in a recession, moving into depression, depending how bad it is and how long it takes us to recover. The tough thing about this is it's hard to tell exactly when we see it hits because there's a huge surge in the stock market right now. And we talked about a little bit about this before in the past, and I want to make sure that's clear, especially for any new guests or viewers inside this stream right now, which obviously it's not showing correctly again. I'll have to refresh this in a little bit. Is how the Fed works and what they're doing and why it's causing the market to go up. So just touch base on that real quick for all the other folks who've seen or listened to this. Hang tight. Is that the Federal Reserve just printed in the last month or so about $2 trillion plus, and then they brought in about another $1 trillion of outside investment from foreign investors, investment companies, countries, things of that such. And so about $3 trillion jumped into our market, or the U.S. economy. And what that essentially does is that you would think it creates inflation, but it doesn't. If anything, it creates deflation, which we'll get into a little bit later. And that's because $3 trillion enters the market. That $3 trillion isn't implemented right away. Right now, we're seeing the highest rating or the highest number of people saving because it's uncertain times. And in uncertain times, people save. And that's exactly what happened in 1929 during the Great Depression. The only difference is that people saved by pulling money out of the bank, shoving it behind the wall or underneath their mattress. Okay, that caused the problem. I forget what it's called, bank running. I forget the name. When you go to the bank and you pull out your money, that causes a huge problem. FYI, the head of the Federal Reserve actually came out and said, "Please don't run to the banks and pull out your money." That's like the worst. It's like me saying, don't think about zebras, right? You can't not think about zebras. And so you don't want to alarm the public by saying, don't go to the bank and pull out your money. We're okay. Because people are going to want to run to the bank and pull out their money. Anyways, so why inflation? We haven't seen inflation yet. It's actually relatively low, under 2%, I believe, is because people aren't spending it. People aren't going out buying watches. They're not buying cars. That $3 trillion is basically going to pay basic essentials and getting shoved into the banks, and for some of us into the stock market. But what ends up happening is no matter what is when you create that much money, we're talking about trillions. We don't normally talk about trillions. Just to give you an idea how much 1 trillion is, I believe it's, if you had $1 for every second, it would go in a trillion. You'd go out like 31,000 plus years and some change, 31,000 years. Okay. And we just printed 3 of those. So almost 100,000 years worth of money if 1 second represented $1. And we are looking at more with another stimulus. And what that does is it devalues the US dollar. Okay, you guys understand that, right? Imagine if you had I don't know if you guys used to trade baseball, basketball cards. I used to as a kid. Is that if you had a Ken Griffey Jr. rookie card, 1989, I believe, and there was only so many made, and then some got destroyed and such, right? And say that only 1,000 were made in the entire world. If all of a sudden somebody went out and Upper Deck or whoever printed it, printed another billion of those Ken Griffey rookie junior cards in 1989, it would lose its value, right? It goes down in value. Same thing with the US dollar. So once I think we had 15 trillion in the market at that time before they printed or brought in another $3 trillion. Now we're at, let's say, 18 trillion going up every single day. It devalues it. And when you devalue something, what ends up happening is asset prices goes up because outside foreign investors can come into the country, China, Europe, and they can buy things up, causing stuff to inflate. And people who are in better financial situations, they can buy things up because they have more money. Okay. So for example, a big hedge fund investor or whomever, banks, whoever can get their money on the cash, that $3 trillion extra, they can go out there and buy more Facebook or buy more Alibaba or whatever, or buy more commercial properties. Does that make sense? Let me know if that doesn't make sense. Juggernaut, what's going on? I'm glad you're thinking about zebras. What was I talking about? I was just talking about, oh my gosh, I just lost my train of thought. Now I'm thinking about zebras. We talked about inflation. Oh yeah, asset prices goes up because all this money is being spent and things are being purchased because the devalue of the dollar makes the euro stronger, makes the won stronger, makes the yen stronger. And so they buy up stuff. And then the rich people or the wealthy people have more access, more money to put into assets. Okay. Now, how this relates to the depression and when the depression is going to hit is that we're watching the cycle unfold. Right now, there's over 40 million people unemployed. Now, that's kind of a false lagging number because a lot of them are temporary unemployed. But even in the best case scenario, everything goes back to opening tomorrow, which is kind of happening right now. If 20 million, half of them went back to work as companies slowly started opening, that's still 20 million people unemployed, which is, I believe it's more than double what happened at the peak of 2009, okay? So it's not like we can turn this economy back on. That's going to take time to happen and for the market to work itself out. Right now, the stock market is so unrealistic and it's way ahead of itself. And a lot of that has to do with the devaluing of the US dollar, but it has a lot to do with just the emotional ties to oh, we might have a vaccine. Oh, the US economy is opening up. Oh, South Korea is doing better. It's not based off the fundamentals of business. And this is what the channel is all about. When I talk about my rentals, when I talk about investing, it's all about fundamentals because you can't rely on emotion, especially human emotion, right? Or investor emotion. It's you have to rely on something like the fundamentals of business or the fundamentals of a rental property. And that's how Warren Buffett, perhaps the most brilliant investor of all time, possibly, he always relies on fundamentals. He does one thing different is that he has money to actually buy into companies. He actually buys large portions of the company where he can go in there and influence leadership and decisions made, which always builds up the foundation or the fundamentals of that business. Okay. So what's going to happen is that the depression, I believe, is going to hit us on a couple of different fronts, right? We've got unemployment. That's one huge one. If a lot of America is not working, that means we're not producing GDP and we're not paying a lot of folks, right? Two is the commercial real estate side. We are watching Twitter, Facebook, a lot of these tech companies that don't require you to actually physically work inside a space saying yeah, stay at home, work from home. This is awesome. We can cancel our $10 million lease in our in this building, right? And by the way, I'm talking about several millions of dollars per month, right? So when you hire and you have employees that are counts in the thousands, tens of thousands, you're paying millions, tens of millions of dollars each month just in lease payments. And then you're not even talking about utilities, printer ink, paper, right? I remember our old company, we went through tens of thousands of dollars in paper and ink each month. It was ridiculous, right? So for a large company like a Facebook or a Google or an Apple, you're talking about perhaps hundreds of millions of dollars a year. And so if you can say, hey, everybody work from home. And by the way, we don't need to hire people just from Silicon Valley or just from this one area. Now I can hire you in India. I can hire you. That might be a little bit different, but I can hire you in California. I can hire you from New York. I can hire you from Montana. And we can all work together and collaborate on Zoom or Skype or whatever. And we can produce a better product or just as good as a product and save $200 million a year. That means commercial real estate is going to go down. And what ends up happening is you have to find the commercial real estate that does buildings that rent out to large tech companies like that don't require face-to-face interaction. And then also the types of businesses that are affected the most by COVID-19, which are restaurants, theaters, daycare, gyms. Those type of places are going to get hit really, really hard because remember, they're not going back to full capacity. They're going at best maybe 50% capacity. And those types of businesses, they work on very thin margins. Margins meaning like if they get paid $1, they get only maybe keep like 5 cents of that $1. 95 cents goes to rent, employees, so on and so forth, expenses. And so what ends up happening is if you cut their revenue in half, now they're making even less money and they might as well just go out of business instead of just losing money. You guys get what I'm saying? So commercial real estate is a second front. So we got unemployment, commercial real estate, and then the third front is going to be ultimately us, like people like us who just finally feel the burden of either not working, of not having enough savings saved up to kind of float us during these times when we don't have a job or expenses go up or whatnot. Okay. And once we see all three of those things line up, we can definitely see another dip in the market. Not even a dip. I'm going to say a major crash, just like the last one that we saw during the second week of March, right? It might even be harder because right now the stock market, you guys, gals, we are basically at even level with where we were at pre-COVID-19. Okay? Just think about that. We had one of the best booming periods ever in the history of the stock market, in the history of the US. We had one of the best markets in the last 10 years. Okay, we had a little bit of a correction in 15, a little bit of a correction in 2018, but overall, the line basically went up. And during this time where we are expecting, I think they're expecting for quarter two for the US GDP, we're going to be down between 30 to 40%, okay? Down 30 to 40% in our GDP. We are trading in the stock market at nearly the same levels as pre-COVID-19. So what was crazy about that, and we've talked about this before too, is that pre-COVID-19, everybody was saying, you guys can go back and look at my previous stock videos. I said that we're going to a recession in 2020, 2019. We're moving into recession. And the reason behind that is I had no idea about the coronavirus, but you could see how grossly overvalued companies were, right? So you guys remember the multiple, the PE ratio? When I say like a company makes $1 and you're willing to pay $20 for it, right? That's an average. $15 to $20 is usually average for every company or for every dollar a company spits out or in the overall market. I'm willing to pay 15 to 20 times that, okay? The average was so much higher, so ridiculous for these companies that weren't really producing that much profit, or they were using profits to buy back their shares, which is a whole nother conversation, is that we saw that overvalued in 2019, beginning of 2020. Those companies were actually producing profit. Now companies are not producing profit and they are valued just as high. It's mind-boggling, right? Chipotle is one of them that we've talked about. Costco, Home Depot, all these companies, because it's influenced by the market and it's emotional. And so people think like, oh, Costco's going to do great, so they buy Costco. What they don't see is that their numbers are not that great. Costco actually posted their first dip in sales in, I think it's like 15 years or 14 years, but the stock price went up. How is that? A company makes less money, but the stock price goes up. So the stock market's a little bit ahead of itself. Sorry, a little bit emotional about that. See, there you go, human emotion. All right, let's go over here. Mark, I agree with you. There is going to be a recession. There's going to be a fire sale. We don't know where it is. I think we are going into depression. I don't think this is a recession because you guys, a recession is like the official term is 2 consecutive quarters of losses, right? The first quarter is a dip of, I believe it's 20%, and then it continues to drop for another quarter. It's not a question anymore if quarter 2 is going to be a down quarter. We absolutely know with 100% of a doubt it's going to be a down quarter. We don't even need to see the numbers. All you have to say is like we had 8 weeks, 9 weeks of a closed economy, right? If I take away your job for 9 weeks, can't we just assume that you don't have that much in savings? Yeah, because you had no income coming in. We know that you're not going to have much in savings. It's just clear. So we know that we're in a recession. It's going to be how bad of a depression is this? How long does it take for us to turn this around? One other note that I want to talk about too, actually this is the other front, is we're in an election year. And we have a very unique president in the sense that he and his administration will do almost anything. And the Federal Reserve has already said this, is they will do anything and everything to basically right this ship. And I don't think you can fix it in, what is it? How many months away are we? We're 4 or 5 months away from November. So it's interesting because what they can do, remember the button and the lever that they can pull, or I guess it's a dial and a button, right? The dial is controlling interest rate. The button is to print money. They can't turn that dial anymore. It's at zero. Well, I guess technically they can. They can go negative. I do not think they will do that. I also talked about this. Nobody believed me when I said that the economy would go to 0% or possibly zero or negative interest rate. Look at this. We are actually discussing having negative interest rates in the United States. We're already at zero. I think it's like 0.25%. We're basically at zero, okay? And then they're just printing that print money. One thing you guys don't know is that you're just like printing money that's bad. It's actually not a horrible idea if you're standing on the side of the U.S. government because they're basically getting this money. The U.S. government has to borrow that. They borrow it from us. When they print money, they're basically releasing bonds to borrow that money. But they're borrowing it at 0.25%. It's as close to free money. If somebody came to me and was like, hey, I'll give you 0.25%, how much money do you want? I'm like, give me all. Give me all of it. If you gave me interest rate of 0.25%, I'm like, yeah, just give me as much as you possibly can give me. Right? He's like, well, what about your income and all your debt to income ratio? I'm like, I don't care. At 0.25%, I can put it in a 10-year CD at 1.5% and make more money off of it. You guys see what I'm saying? So the U.S. government can take that $3 trillion, this is all in theory, obviously, and take that $3 trillion at 0.25, 0.5%, and they reinvest it back into the U.S. economy, which will spit out 2.5%. 3%, 4%, 5% return in the next 10 years. Do you see where I'm getting with that? Now, the problem with that is that they consider short-term solutions that creates long-term problems. By printing a bunch of money now, and even though it pulls us out of this like recession, it gives us this overvalued stock market, right? And it's not sustainable. And when it drops, think about your retirement, that's another thing I was going to talk about. Somebody asked about. Is that it fixes our problems now that are not retiring or not close to retirement age, but in, let's say 12 months, let's say we fix it, Trump goes back into office because everything's fixed. 12 months from now, the market is even more overvalued, and then we all see it, and that bubble pops, right? Whatever pops that bubble, I don't know what's going to pop that bubble, but let's say that pops that bubble when it's so severely overvalued, and now people who are 60, 61, 62, 63, 64 years old getting ready to retire, they see their, let's just say $1 million nest egg drop to $600,000. Like that, right? And the problem with that is that they need to live off of that money. And so each year that they pull out, now this doesn't even talk about all the folks, the baby boomers, right, which is a large majority of the U.S. They are currently retired, and they're pulling out several thousands of dollars from their retirement fund every single month. So now they just saw their retirement fund get chopped in half. This happened in 2009. They see their retirement account get chopped in half, and then they have to still continue to pull out money, which is the worst thing to do because you're just pulling out losses, right? You don't want to pull money out in a down time. If anything, you want to be putting money in. So it's a bad thing. So that's why I really see a depression coming. In terms, we're going to have to wait and see this issue play out for it to really happen. I can't predict the future. I wish I could, you guys. But I know it's going to come down to two things. If you guys want to keep an eye on it, it's going to come down to those two businessy words that I talked about before, liquidity and solvency, right? Liquidity is just how much cash you have. Solvency is how much cash flow you have. Because I can give you $10,000, shove this in your bank account, and you're like, awesome. I'm like, by the way, you won't have a job for the next 24 months. You're like, what? I'm like, yeah. You don't have a liquidity problem right now. You have a solvency problem. You have a cash flow problem. You don't have cash flow coming in. That's what's happening with big companies. For example, Disney, right? Even Costco is having a little bit of a solvency, not really, but kind of a solvency problem because their cash flows are not as high because their food court was shut down. Their eye care, their ear, what do you call ear? Their hearing aid center was shut down. The picture, the photography was shut down. And so what that does is it takes away a lot of cash off the table. And that's with a good, strong company. Keep in mind, you guys, our stock market right now, gosh, what was it? I was just looking at this number. The S&P 500, the top 10 companies, the top 10, so 10 out of 500 make up over 25% of the value of the S&P 500. Okay? You're thinking about that? 25% of the S&P 500, and that I might be off by a percent or two, is made up by the top 10 companies. That's the same thing. You guys remember the whole, or not remember, but you guys know about the whole gap, the wealth gap, right? Equality, all that stuff. That's the same problem that we're seeing in the stock market, right? The Facebooks, the Microsofts, the Apples, they own the lion's share. So when they do really well, like which they are, it doesn't exactly reflect what's going on in the market. So if everybody's buying up Facebook, Microsoft, Apple, what are the other ones? Johnson & Johnson, Coca-Cola, maybe? No, not Coca-Cola. Qualcomm? I have to take a look. But those companies are doing well, but what about the other 490 stocks that are suffering, right? Or just kind of like muddling along. Maybe even some of the, number of 310 drops off, goes bankrupt, right? Or maybe, they have huge dips in sales. But you don't see it, or we don't see it because the top 10 stocks are doing well. And that's what's really hurting the market right now too, is that people don't see that, or investors don't see that. They're like, oh, S&P 500's up 2% today. Oh, it's up again 3% today. It's like, not really. It's just those 10, 11 stocks, those companies are doing well. The other 490 are doing horrible. All right, let's jump over here. Dude, I've already been on here for 38 minutes and I'm still yakking away about stocks. Goodness gracious. All right, let's talk about my gamble here. All right, let me jump over here real fast. Cedric, what's going on? Paradoxmus, right? It's Cedric. I am very interested in which vehicle you're using to short the American economy. Devin Kemp, what's going on? Devin, I don't think I've seen you in here. I feel about the app worthy. How do you feel about the app worthy? Its bonds. I'm not familiar with the app worthy. Tell me more about it, or I'll look into it. Here, I'm gonna add this in. You guys are asking good questions. I'll look into that more in here a little bit. All right, let's switch this up real quick. I'm gonna refresh this so I can see everybody in here because I can't see you all in here yet. Hopefully this doesn't short you out. Oh, there's 15 of you guys in here. Awesome. Of course I remembered your name. You're a regular. You guys are all OGs, right? You guys are watching my live stream. Okay. Boom. Can you guys see this? I'm going to go to my Robinhood portfolio. Okay. So I told you guys this about before. I have my watch list here. And then I threw in $25,000. Obviously, I'm down right now into... let me open this up so you guys can see it a little bit better. into my stock portfolio on Robinhood. Okay, so basically what I did here, and I want to say this very disclaimer: I am not a financial advisor. I'm not telling you what to do, how to do your money, or what to invest in. This is how I'm doing it, and this is for my risk tolerance. If you have more money than this, awesome. If you can lose it, do it. If you feel comfortable doing it. If you have less than this and you can do it with only maybe 500, do it with 500. Everybody has to start somewhere, which I want to talk about compounding here in a little bit. But this is what I feel comfortable with. And you guys got to remember, this is $25,000 I don't want to lose, but if I lose it, I'm okay. Okay. And I got a couple of questions. I want to address this real fast. I've got a couple of folks who's like, hey, I've got $20,000 saved up. I've got $30,000. I got $10,000 saved up for my rainy day fund. I want to invest in the market. How do I do it? First thing I write back always is don't do it. Not your rainy day fund. Okay. You have to have a certain amount of money that you put aside. 6 months is ideal. More than that is actually ideal. But 6 months, bare minimum. 2 months is the bottom line. Baseline, always have 2 months in your savings account. Outside of that, how you invest, that you have to have an even smaller portion to invest in what I'm about to show you right here. So this is actually a small portion of my portfolio that I'm willing to lose, right? So right here is $25,000 I threw in a Robinhood account. I usually like to use Thinkorswim as my main primary account that I'll be using to invest. But like I told you guys before, I sold all of my stocks, okay? Right now, the market is way too volatile for me to really hold on to any stocks. I even sold my index funds, which I've told you guys don't sell those. I sold them because they're trading at a higher value than pre-COVID-19. If you want to talk about buy low, sell high, selling high, I sold high, okay? So I'm betting against the U.S. market, and I know that they say, even Warren Buffett says, don't bet against the U.S. economy. To a certain extent, it's all about timing, right? I'm not saying I know how to time it, but we know when things are inflated or so grossly overvalued, and how I'm betting against the market is really a couple of ways. And this is going to answer your question right here, Cedric. Is I'm buying gold, okay? Gold is a great thing to buy into, and I'll address this on a couple fronts, is when you don't believe in the US dollar or the currency that you're in, right? And it's a great wealth holder, not necessarily a great investment vehicle because it kind of fluctuates a lot. But what ends up happening is precious metals or gold, silver, I think more gold, it'll tend to outpace inflation, which is around 3%, okay? And so what you can do, that there's these ETFs where they will track the spot price of gold, and they actually back it up with gold that's held in vaults. These ones are actually, GLD and IAU. I believe they hold their gold in vaults in London. Make sure you do your research. Make sure they're legit funds. And even that is risky because what I should be doing and what I really should be doing, and I will do it, is I'll probably take out a couple of $1,000s from here and I'll actually buy real gold, like coins or gold bars. The reason behind that is because in a market that's this volatile, it's just strange to also hold on to a representation of gold through the market. In essence, you should be holding on to physical, to diversify is to hold on to the physical asset of gold itself, okay? So gold is one way of that's why we see gold prices shoot up when the market goes down. It's because it's you're diversifying and you're hedging your bet against the market. That's one way. So I'll be investing probably, I'd say 20% of this into precious metals. So maybe about $5,000 to $6,000 into precious metals. Ignore this one share. This one share is because one of you out there was nice enough to use my Robinhood account and I got a free share. We actually both got free shares. I'm not sure what you got, but I got $5 of this one company that I have no idea about. And I can't sell it yet because I have to hold on to it for 3 days. But yeah, I'm not going to hold on to that. Now, this is the really, really super risky part. Okay, so I've talked about this a little bit before in the past. There's these funds, ETFs, that do the inverse of whatever index you're looking at. So there's a Russell 2000, S&P 500, the Dow Jones. You can find these funds that do the inverse, okay? Now, I'm getting super risky, all right? I am not 100% certain on this. I'm just going to gamble on it. I'm going based off of my experience and what I know in the past. You should not do this. But what I'm saying is I chose a fund that is 3 times as intense. So basically what happens is if the S&P 500 goes up 2%, this fund right here, this ETF, will go down 6%, okay? But if the S&P 500 goes down 2%, this fund goes up 6%, all right? And this fund is not meant to be held on to. It's super, it's the closest thing to gambling because of how this fund is set up and how they do the inverse. It's all shorts and bets and gambles against the market. So you never want to actually hold on to shares of this. What I purchase are options. And if you don't know what options are, it's really, there's a bunch of really great videos online just to understand what options are. Is I purchased call options betting that this will go up by 2022. Let me just double check. I got a couple of them. So I'm slowly buying into them as the price goes down because obviously the market has been going up. So this fund has been going down because it's the inverse. And each time the market goes up, this fund goes down, it gets cheaper for me. So you can actually see that I've bought about $2,000 worth right here so far. And I've lost, right? About almost $1,000 because the market has been going up. That's okay. I haven't sold these yet. I haven't exercised the options yet. So I haven't actually lost that money. And these are a ways out. I mean, the closest one is this January, this upcoming January. So it's still another 9 months away. And then I have, no, I'm sorry, not this January. Next January, January 2022. I got 2 of those. The closest one is a year from now, next June. Is I'm betting that this will eventually go up because the market will crash. So I'm basically giving myself between 18 to 12 to 18 months to see this market crash is what I'm betting on, okay? Now, this is super, super risky because if it doesn't go that way, I lose this money, right? And so I'm going to be spending the rest of this money buying funds or calls, options similar to this against the market because whatever we're doing, it's not sustainable. I love the US. I love the economy. I love the free market. I believe in us. I believe that we will come back. But what we're doing right now is so unsustainable. It's not correct. And we can't float this forever. Just like how you and I, we can't float forever with credit card debts and mortgages and car loans and all this stuff without income, right? Or even saying minimum wage. It's like you making minimum wage, but you have a brand new nice BMW, you've got a Tesla in the car, you got a Rolex on, you've got $1 million home, and you have, $10,000 in expenses to upkeep your home and clean your pool every month, right? You're just like, it's not sustainable, right? You probably do it with enough loans and credit cards. You probably do it for a few months, maybe even a few years. That's what I'm betting on, is that the market can't support what is happening right now. And so I'm betting against it. So obviously I haven't implemented all 25,000 yet. And I'm hoping, I'm trying to float through. I think we're going to see a really rude awakening in July, August, when Q2 numbers start coming out for both the U.S. economy and for companies. And we should see, I'm hoping that we see that this short on the S&P 500 go up. And as you can see here, and I showed you guys this last week, as you can see the spike here when it shot up to about $42, $41 when the market had that big crash, right? And so I'm hoping that we'll see another spike in the next couple of months when this happens again. Does that make sense? Okay. Gen A places, I've been looking at places online to buy gold. There's a bunch of places. There's one place called goldsilver.com. There's another one that you can just Google. The reason why I haven't purchased it yet, Jen, is I want to look more into it and research it, because there's ways for you to buy gold and you can actually have it shipped to you, which Sounds super sketchy, right? Can you imagine just them shipping just like $10,000 worth of gold to you? But then and then where do you put that? You have to have a safe in the house or bury it somewhere in your backyard where nobody will find it. But then there's the other places where you can, you buy the gold and they actually store it in their vault for you, right? And then they charge you, I think like 0.4% a year or something like that to hold on to the gold for you. And the only thing is, don't buy jewelry unless you already have it. Don't buy jewelry. Don't buy it from pawn shops. You will always pay more. Okay. And then don't sell it to them either. If you have to sell it, make sure you go back online and you sell it through one of these distributors that are legit. But yeah, definitely, if you find one, let me know. I'm still doing my research on that. Ryan Bays. Ryan Bays? I have a friend that I went to undergrad with named Ryan Bays. It's not you, is it? Ryan? You didn't go to did you go to Oregon State? Are you a Beaver? Gold market did. You're absolutely right. Let's just take a look at this real quick. Gold ETF. And this is part of the reason why I'm saying that it dipped a bit. It dipped quite a bit. It went from, 158 down to 138. What is that? That's a rough 20 bucks. 20 bucks. So it dipped a little bit less than the overall market. I think the market lost about 30%. This one lost about, 15%? Is my math right? I think it's about 15%. So when it dropped about half of what the market did, it rallied back just as much. So that's why I think it's better to have the hard asset of gold, because again, at the end of the day, you're still trading a stock is what you're doing. So diversify, right? Good point, Ryan. Thank you. Knockout option, Cedric. I've never heard of that. Yeah, you guys just remember, this is completely my gambling position. This is not my actual portfolio. I'll be buying, my portfolio is what I shared with you guys before. It's going to be all these companies over here that we value, right? The main ones right now that I'm looking at, Disney, I want some, Home Depot, Starbucks, Chipotle, Nvidia, Marriott, AMD, once they reach fair value. Once these all drop, this is my waiting list, you guys. This right here, these are just my waiting list of companies that I've lined up that are solid companies. The only ones that I won't invest in are, which one are these ones? These ones that are marked up in red down here, because they don't make sense. There's something weird. O'Reilly's just so ridiculously overvalued. I think they're trading at 125, 130x. It's so freaking ridiculous. It doesn't make any sense what's going on. So, okay. Moving on. That's my gamble. Compounding. Okay, one thing I want to show, because I know there's, how many of you guys are in here? Let me refresh this so I can see. By the way, just a quick update on house. If any of you guys decide to buy a house or build your own house, don't ever use metal siding. By the way, I'm thinking, what do you guys think? I want to start. I'm going to start another channel that's just on building. I'm not a building expert. I built my house. I do remodels myself, and I think I'm just going to break it down to just be like, because I'm so. Scale 1 to 10, 10 being expert, 0 or 1 being you know nothing about building. I'd say I'm like maybe a 6.5. Okay. And I think that there's a lot of folks out there that float around who are just DIYers. They're at home. They don't have time to build. They float around like maybe like a 2 or 3. I'm making videos for that demographic of what to look for. Not even have to build, but just like if you're looking for, like, I don't know if you guys can see, I built that closet, that walk-in closet. There's so many things that I didn't know that I had to figure out. But when it comes to siding, don't ever buy a house or build a house with metal siding. 3 reasons. 1, it's freaking loud, okay? The reason why it's loud is there's no sound dampening. It literally transfers the sound from the outside to inside. So if a plane, helicopter, truck, car, people talking outside, birds, annoying birds, you'll hear everything. Also, it's a horrible insulator. If anything, it radiates and it pulls in and out energy like nothing, okay? So at least with fiber cement or wood, you have a little bit of an R value of insulation. With metal, it's basically 0. It just transfers heat like crazy. So what happens is in the wintertime, the place gets really cold, and in the summertime, it gets super hot. And then the third one is that it expands and contracts a lot. Okay. And what I mean by that, it's just really loud. You'll hear throughout the whole house. Right now it's actually overcast, so you can't hear anything. Is that you'll hear huge cracks as the house expands and contracts. I'll never do metal again. So right now, basically residing the house and insulating the exterior and then putting on fiber cement hardy panels, kind of like this more modern. I'll give you guys I'll keep you guys follow me on Instagram. I'll show you guys more photos. I think I have a couple photos on Instagram. Maybe I don't. I don't think I have yet. Okay. What were we talking about? Compound. Hey, I want to show you guys real quick. Okay, for those folks who don't or who haven't started investing or need to understand, not need to understand, but one thing. I want to paint a better picture for you of how investing works. And I'm not talking about investing in just like the stock market or real estate, but I'm talking about your mindset and how you save money and how you build money over time. Okay. So real quick, let me see if I can do this with this microphone without completely destroying or dropping this. Okay. So we're going to do I'm going to show this real fast. Okay. And then we'll get into valuing Facebook and then answer guys' questions about Alibaba and like 401k, retirement accounts, that type of stuff. Days, money. Whoops. What am I doing? I'm all over the place. Okay, so days here, we'll just do this as like day one. And for you who already know this experiment, this is like what you do with your kid or your niece or nephew. It's like, hey, I'll give you $1 million today, or I'll give you 1 cent today. I'll give you 2 cents tomorrow. The day after, I'll give you 4 cents. And basically, I'll double your money every day for a whole month, okay? Let's say we pull it out 31 days. And what you do, make this larger so we can see the whole thing. Let me just pull this out a little bit more. Boop, 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 boop. 27, 28, 29, 30, 31. And what happens is that obviously you're not going to get a 100% rate of return every single day. But this proves the point. This could be months. This could be years. This maybe even decades. And what ends up happening is that most people, they live in this realm right here. Let's do this. We'll do this red. I'm gonna try to be as PC as possible here. Okay, this is where the poor people live. All right, is when they start investing, whether it's $1, it's $2, it's $100, it's $1,000, it's even $10,000. Is that they see such slow growth? They're like, it's only 2 cents, or like even to the mindset, right? The big thing that I talk about is discipline, mindset, adapting to change, embracing change. Living below your means, all that stuff, right? That we'll get into some other time. But the poor folks, they make this progress. They're moving forward. But 1 cent to 4 cents isn't that much. Even 1 cent to 64 cents doesn't seem like a lot, even though you made 65 cents off 1 cent, right? And they usually end up quitting here. They pull out their money here, or they quit here, right? And then even when they make it into this next realm, it's still not that much money, right? And we'll say this is like low mid. And so some folks can get into this area and they, it's like, it's only $20. I want to go on that vacation. I want that new car, whatever, right? And they break their discipline. They give up, or they stop, or something happens. Like, God forbid, like a health crisis happens, or you lose your job, or whatever happens, and they have to put things on pause, right? And they pull out here, or even they pull out here. They're getting the hundreds. Now, the problem, or not the problem, but the thing with wealthy people, rich people, however you want to define it, is they're able to get past all of this. And then they start playing in a different game. Just for example, somebody who's playing in this realm right here. I know I'm kind of all over the board right now, but just try to follow me. Somebody who starts playing in this realm right here, they'll almost never have to play in this realm again. Does that make sense? Because it takes you 7 days to make 64 cents. And let's say that I, or one of you, let's take Russell, he plays in this realm right here. He will go between $1,300 to $42,000, right? In a 6-day period versus a 7-day period. But, you guys get the point. He'll always be playing somewhere in this realm. He will never play in this realm unless something horrible or horrific happens. But like in terms of investing and his cost of living and how his quality of life, he will always be in this realm as long as he follows his discipline. All right. Now, if you continue moving down the road here or down this chart, you start seeing how rich people play. And this is the true power of compounding. You get to a point where one day or 1 year moves you from 42,000 to 84,000. All right. And you make it all the way down here. Now you're playing in like God levels, right? You're playing in tiers that are just ungodly. Let's highlight this. Now you're playing in tiers where in one day you make $5 million. And that's why we're always talking about Elon Musk. He makes $20 million an hour. He just got a bonus for $800 million for 2 months or 3 months of work, right? And we can't even fathom that, right? And I'm not saying I'm nowhere near that level. I don't think any of us who are watching are on part of this channel, but the mindset is the same, right? There's certain things. I wouldn't trade the world for Elon Musk's life. I couldn't handle 5 businesses even if you gave me $1 trillion. It's not worth it to me, like how much he works. But you have to ask yourself what you're willing to do and then what type of life you want to live. And the point is the saying that we say when we victimize ourselves and say like the rich get richer, the poor get poorer. It's not necessarily because it is in a sense sometimes, yes, you're right, that they buy politicians and they do all that stuff. But the reason why the rich get richer is because they're playing in this realm here. They paid all their dues these past 29 days. They held their discipline. They followed the rules. And then now they're playing with 5 million and that turns into 10 million one day. Whereas certain people, they play in this realm down here and they give up on day 2 or they give up on day 3 and they play between 1 cent and 4 cents. Does that make sense? And so that's why when I'm talking to you, and I get a lot of high schoolers and younger folks, men and women, who are trying to start in that 17, 18. And man, I wish I had started that early, right? I started right around 21, 22. And if I had 4 more years, imagine each one of these days represents a year, right? It would make the difference between 1 million and almost 11 million. And so I want you to think about where you are at on this scale. And I would say if it was personally me, I'd share with you, I am probably playing around, I'm somewhere in this green area. I'm probably like in day between, I'm playing like between day 25 to 28. That's my area. Okay? And when I play stuff, when I go out and buy stuff, I can go buy a piece of property for like, $500,000, $600,000 right now, right? Today, if you showed me something, right? I could go invest that $25,000. If I lose it, it sucks. I'm not saying this to brag or be mean about it, but it's you didn't see the last 14, 15 years of my life where I started here. Right? And this is the same for you. And I see so many people, and this is my good friends too, and then family members, that they play this game or they do invest, they invest and they stop here, or they stop here, or they stop here. And I'm saying you made it this far. If you did that again, if you did another 15 days, you might not be right here, but you'd be playing up here, right? And that's the name of the game. Is that you want to get to a different stage each time. And that's the power of compounding, right? And I told you guys my strategy is very different than most people's, or the traditional sense, right? It's like I don't play it to like try to make 10% each year. I mean, obviously you can average it out, but I'll play it where I want cash and I might lose 1% or 2%, maybe lose 10% in a year. But then I have one big year where like right now, I think that I could have a couple really big years is I'll make 3, 4, 5, 6, 7, 800% on my money. Does that make sense? Okay, enough about compounding. Let's answer some questions real fast. Of course, that's all right. Juggernaut, what is going to be the market response after the anticipated Q2 loss? Is there a mass panic? You know, Juggernaut, the market has been, that's a great question. That's something that I've been thinking about a lot too. It's so insane with how the market's reacting to everything. And so the market, like there's like vaccines that potentially may work. They're still in the first phase of like 17 phases. And then that's an exaggeration. But then the market increases because of that. And then when companies are saying, hey, we're losing a bunch of money, like who said that? I think Costco said they had their first dip in 15 years. Their stock market went up. It's very volatile right now. That's why I've sold all my stuff. It's not following basic fundamentals of business. And I don't like that. You can't invest in that. But I believe that when Q2 comes out and they show that the GDP has dropped between 30 to 40%, that's a rough estimate right now, and that you see the vast majority of the stock market between July and August and they come out and they show their earnings, I think that that's going to be a rude awakening. And on top of that, as we can see, is that Alabama, I was just watching this morning before I turned on the live stream, is that these counties and these states that have been reopening, they're not just seeing an increase in cases, which is obvious, right? Very obvious. But now they're starting to see that they're running out of ICU beds and they're seeing more people going back on ventilators. Which is the huge problem, right? It's not the fatality. It's not even the number of cases. The main problem that we should all be considering is how many people are going to the hospital. Because if the hospitals are filled up, that means you, me, anybody, I'm working on my house and I have an accident and I need to go to the ICU. There's no ICU beds. And if I go to the ICU and I have a broken arm or I'm concussed or whatever it is, and I am now concussed with a broken arm and internal bleeding, and I also have COVID-19, it makes things worse, right? So that's the real problem. It's not about obviously it is a little bit about the number of cases, and it's obviously about the fatalities. I have an elderly grandparent, I have elderly grandparents, and I have older parents. I would not want anybody out there to get it. But at the same time, it's about the hospitalization rate and how full hospitals are for everyday accidents issues. And so once we see those numbers start climbing again, and this, I do believe that we'll see that happening in July and August on top of horrible earnings, hopefully, and I'm hoping that the market will respond accurately to bring us back to a level-headed area where these prices will go down. With that all said, if we see this, and I'm sure that we can do this, and this is me predicting the future right here, is that if Q2 comes out and all these earnings statements come out, and they're all horrible, they're losing money, they're not profitable, they don't see an out for this, and we see increased hospitalization rates and a second surge or the beginning of a second surge in COVID-19, I bet you the Federal Reserve will start buying up more assets and increasing their balance sheet. And Trump's administration will release another stimulus and print more money. They'll push that button, print more money, infuse it in the economy, shooting up stock prices and home value, which is great for me. I mean, I have homes, I have properties. That's fine. I can't really cash in on it right now because I'm not going to sell anything. But it'll increase asset prices until election. And then I think next summer we'll feel the wrath. So it can go either way because right now they have the powerful government or the Federal Reserve has that way of pushing that button. And so that just kind of throws everything in a loop. If you took that button away though, and you took away their power to like manipulate the currency, yeah, absolutely. I'd say Q2 we're going to have the worst crash we've ever seen in the history of the stock market. But I don't know because it's election. The thing that really throws a monkey wrench in all this is that it's election. You guys remember, it's election year. They will do everything and anything in their power to get reelected. That's our government. Good question though. Ryan Bay's one and the same. I forget. Yeah, you're right. It is. You're right. In certain dips in the market in in recessions is that you will have certain outliers, but ETFs is still a part of the market, and if the market dips, you'll see it dip too. In the long run, gold ETFs will react a little bit differently than, like, say, a Facebook or a Chipotle, things of that sort. But one thing you got to keep in mind is that a lot of don't get pulled into like the gold mining ETFs or the shares or the what's the other one? The ones that bet or track the gold price. If anything, you want to find an ETF. And now that I'm thinking about it, Ryan, gold prices Bitcoin gold prices, everything dipped at the last crash. I think it was just this massive panic. I have to think more about that, but that's a good point. But you want to be able to buy something that actually is holding gold or representing gold. Don't buy something that is just following the price of gold or following like mining or a company that supports gold mining. Okay, that's totally different. You're investing in a different business now. These ETFs are actually, they're reputable. What they're doing is that you are investing and buying the spot price of actual gold bars that's in a vault. Okay. Always learning. Kai, would you be interested in starting a Discord? That way we can still continue these conversations, findings. Yeah, always learning. I actually do have a Discord. Let me see if I can pull it up here. I'll put a link in here. Where'd I put it? YouTube Hangout? Man, I haven't used this for a while. How do I send you guys? Invite people. Edit, invite. Never. No limit. Grant temporary membership. All right, here you go. Copy. Let me see if this works. I'm going to paste it in here. There you go. It worked. That's my Discord. I have not analyzed Chewy. That's a good one. I won't do a full analysis, but I'll read through their financials and tell you what I think. Chewy's an interesting one. I have looked at them in the past because, as you guys know, as more people stay home, more families are home, more people work from home, they're going to want companionship, right? Because if you're not seeing a lot of people, so you're not socializing with folks, we all know that pets and animals, even before this, I believe animals or pets was one of the highest expenses in the U.S. economy in terms of consumer spending, right? I believe alcohol was up there, groceries, and then pets. There was another one. There's three big ones. This was a while ago. I did the study. But anyways, we will see a huge surge in pets. And so Chewy would be a very, very interesting one. Jen A, Always Learning, has a Discord channel. Oh, thanks, Jen. Manuel, there's no problem with level 1. We're all starting somewhere. Spencer, what's going on? You always hear it's about time in the market, not time in the market. With that said, would you just continue the course of regular investing or wait for the decline that is expected? Spencer, that going back to that real quick, that's a great question. You should never time the market. It's about time in the market, but you do it long enough. And if you're in a place where you can cash out and wait because things are so overly inflated, you can. And you can hedge your bet too. You don't have to take out all your money. Obviously, I still have a lot of my money inside the real estate market. Even if things crash though, it's like I'm not really hurting because my payments are so low and I know I can cash flow them or at least break even on them. And so it's how you hedge your bets. So if you're a purely, like, I'm going to use this as an example, you're an index fund investor, I wouldn't say sell all of your index funds. I'm like, sell the ones that you think are that are the most inflated. Right now, I believe the S&P 500 is incredibly inflated because the top 10 companies out of the 500 make up 25% of the entire fund or of the entire index. And so if you know that and you bought in, let's say I'm making this number up, but let's say that you bought into the VOO, which tracks the S&P 500, Vanguard's S&P 500, you bought in at 130 and you sold it, I don't know what's trading at right now. Let's say you sold it at 250. I mean, you already made, what is that? 75% in however many years. Sell it. And if you know the fundamentals, you're just like, I don't believe that this can sustain, then you're okay. But maybe you only sell half of it. But yeah, I believe in hedging, especially in times when you can see something. If you see something happening that's so apparent, and sometimes it's not like you're not speculating, you're just like, this is weird. Unemployment is through the roof. We're at 40 million. We've never had 40 million before. Companies are shut down. Economies are shut down. We're in the middle of a pandemic. GDP is going to drop by 30 to 40%. And this isn't just happening in America. This is happening globally. But we're trading at all-time highs. Every market is at all-time highs. This isn't sustainable. This isn't right. And we're printing money like there's no tomorrow. Something has to give. I don't know when it's going to give. So hedge your bets. But it's very different for people who play up here and for folks who play down here, right? If you have a certain amount of money and you can't watch your, if you have, let's say a $10,000 portfolio and you don't want to watch it go down to 5,000 and you need that money for a down payment on a house, or it's part of your rainy day fund or whatever, I would consider selling right now when things are at a high. Now, with me saying that, also know that I could be completely wrong, and for the next 12 months we're in another bull market and you could have made double your money, right? That's something that you're going to have to justify. I can't justify a bull market with unemployment rates so high and we're seeing commercial real estate at the verge of a full collapse. So just me being dramatic. Good question though, Spencer. I'm personally waiting for the decline. Like I said, I sold all my stocks. Okay, always learning. It'll be interesting to see what happens when the extra unemployment stimulus payments stop in July as well. Q3, I agree. It's going to be very, very, very interesting. See you, Ryan. Thanks for coming by. All right, let's jump into, you guys want to do Facebook? Throw out some companies. So one said Chewy. Another Alibaba, but let's pull up Facebook super fast. So like I said before, I have not looked at this at all, and I'm kind of going into this blind. Man, we've been in here for an hour and 17 minutes. Okay, I'm going into this blind, but let's pull up some financials here and take a quick gander at what's going on and see if we can even value it. And before you guys ask, I know I haven't fixed my spreadsheet yet, so I can't give it out yet. Yes, I've been slacking on my videos. I haven't been able to upload anything because I'm working literally 12-hour days. Do I look burnt? I've got like fiberglass itch all over me because I'm doing the insulation. But I've got this crazy farmer's tan. Not sure you guys can see it. Yeah, 12 hours in the sun, 10 to 12 hours every single day. Okay, so let's take a look at Facebook. So Facebook right now, let's see where they're trading at. Let me just check a quick gander here. All right, so they're pretty high. They're at 31x, but I believe that means that they're profitable, so that's good. Revenues have been slowly growing. I expect them to be growing. So if you guys don't know this, Facebook has just done something that can really change the game. Okay, so we all know YouTube. We're very familiar with YouTube. If you guys don't know this, how YouTube works is that 55% of the revenue, so the ads that you guys see on our channels, that actually helps us out a lot. I don't make a ton of money. I can actually show you guys how much. You guys want to see how much I make off YouTube? This is fun. I've had a couple questions about this, so I'll share this with you guys. So let me pull this over. I know I'm jumping all over the board, you guys. I'll get back into this. Okay. So here's my subscribers. Here's everything. And so if I go to analytics, and I jump over to my revenue, and I go into see more. Actually, this is not a good representation. We'll stick to right here. You guys can see my revenue. So each day off of my ad revenue, I make about $12 and it floats around. I had a peak last month, but I mean, it's nothing substantial, but I mean, $400 or $500 a month it's good. It's good change. It pays for my subscriptions for the music that you hear in my videos, the graphics that you see, my editing software, a lot of some of the stuff that I use to what do you call it? to analyze the stocks. They're all subscription based. They're all 10, 15, 20, 30 bucks, 50 bucks, whatever a month. And I have to buy certain things. I have to buy a new lens. I got to buy this cable to do the live stream, bought this mic. All this stuff, it costs money. You know, I got the GoPro for start filming outside and stuff. And so that $500 goes to that. And to be honest, it's fun. But at the same time, there's potential there to make a lot more money. And how this works is that when you guys see or click on the ads, a little bit of it goes to the content creator or for me. So when you guys watch those ads, it helps a lot. If you use an ad blocker, it really sucks because then creators don't get compensated for all the time and the subscriptions and the equipment they have to buy. But with that all said, 55% goes to us, the creators, 45% goes to the company, YouTube. Here's the crazy part. So you guys know all the stuff like Snapchat, TikTok, Instagram, Facebook, all that stuff, all the social media stuff that creates videos and content, is they don't really pay. I'm not trying to say, I'm going to make sure that I get this right. They don't pay the content creators. They might pay in terms of special marketing things or ads. That's why you see Instagram folks, they're always posting like, hey, check out this new protein bar that's awesome, or like check out this new camera lens, it's great, is they get paid for those ads or they get paid for posting those. But Instagram or Facebook is releasing something where they are going to start paying creators 55%. Now they're starting off, they're doing a slow roll to see how it works out. They're doing just the top 200 Instagram creators, this 55%, to start showing ads on their page. And so what's going to happen is that what YouTube did for how-to videos and educational videos and entertainment videos, we could see the same thing happening through shorter videos and photos on Instagram, which is mind-boggling, because then what's going to happen is that creators, people in general, will always follow the money, right? It's the same thing for us. I'm not going to go invest in a bad stock. I'm not going to invest in a bad property. I'm going to invest in something that's going to give me a good return. And so if Instagram starts saying like, hey, come over here, we'll give you more favorable terms and we'll pay you 55% as well. Come, and instead of spending, 40 hours a week working on YouTube, why don't you come over here and spend 20 hours over here, and we'll pay you some money too. That changes the game. So now you're going to have a flood of good content, probably some bad ones too, going over to Instagram to compete directly with YouTube, right? Because we know they have Instagram TV. We know they do videos. And they're more geared towards phones and iPad versus YouTube is more geared towards desktop computing, and then iPad is like kind of like a distant second. So it's super interesting what they're doing. So let's take a quick look right here. Revenues have been growing, which is great to see. Net income. Now, net income took a little bit of a dip, even though revenues grew. So there's something going on in there. They probably did a big marketing expense, or maybe they bought something big, like another company, which I know that they have been purchasing stuff. I don't know what they purchased between 2018 and 2019, though. Let's see, total debt. So they did take out a bunch of debt in 2019. So that is telling me that they bought something big. Did they? What did they buy in 2019? I'll have to think about that. We'll have to dig deeper. All right, and then as always, we always look at cash flows. So operating cash flows look good to decent. All right, let's plug and chug this thing. Let me see how we can best do this. So I'm gonna move this over here. I'm gonna move this over here. Boom. Let's create a new one here. Create a copy. Boom. All right, Facebook. Let's see if we should invest in you. Now the really cool thing, is if you guys have been following me through this, is we're basically creating a long line. I think we have over maybe 20, close to 20, maybe over 20 stocks now that we've analyzed. And when this market finally reacts appropriately to what's going on, to what do you call it? The cash flows of the company, which reminds me of something. Sorry, I'm so all over the place right now. Is that we can go in and buy the companies that we know that are undervalued. One thing I just want to talk about real quick is that I haven't really talked about before that we should be getting into, and I'll show you with Facebook, is we should always be keeping an eye on the number of shares that are in the company year to year. Because what ends up happening is a lot of companies, they'll buy back shares even if they make the same amount of money. I think Apple did this, and not a lot of people saw this, but Apple did in 2015, they made the same amount of money as in 2019. But what they did is they had a great deal on debt to buy debt cheap. They took out debt, bought back a bunch of shares, and increased their stock price, not because of earnings, but because they reduced the number of shares in the market. It's a really, really sneaky way of increasing stock prices, and it's not a fundamental way, right? Because it's just like you're manipulating the asset itself. You're not actually creating value or improving your business. Okay, so that's one thing that we have to keep in mind. We'll start from now on out. We'll keep an eye on that. We'll take a look. All right, so let me get this sized up right, so we can look at it together. If you guys can't see me you guys can't see the screen because of my little face over here, let me know. But I don't think I'm blocking anything. All right, so current stock price of Facebook is $225. 9 cents. Current PE ratio, what I say? I think it was like 31 or something. So all we're going to do is we're going to go in here. We're going to start. I'm just going to put 31. We're going to go in here and we're going to put in some of the assumptions. And then I'm going to upload the spreadsheets. And then we're going to do a quick analysis. Let's see. Cash. Not bad. 60 billion. In cash. Total debt. So this is a good sign right off the bat, right? They have 6 times more cash than they have debt. Fantastic. If something worst case, Facebook is one of the ones that's going to be growing during this time anyway, so it's not a huge surprise. But that's the type of thing that we want to see in companies. All right, let's see how many shares outstanding. So they have 2.8 billion shares outstanding, and I'll show you how to find out how many shares they had the previous couple years. Tax rate, we don't know yet. Average interest on debt, we don't know yet. Discount rate. Okay, so this is the part where we come in, and this is the value investor side of this. This is where all these two numbers right here, this is where your experience and training, it comes into. Everything else is very easy. Right? It's just right here. It's like an art. So discount rate, remember, it's the risk premium. It's usually whatever the baseline interest is. Like if you put your money in a savings account, how much interest can you get? That's your baseline guaranteed money. And then you add a risk premium on top of it. So now you get like my best account is Ally, I believe. I think it's 1.5, maybe 1.25%. I think it's 1.5%. So I'll use a baseline of 1.5%, and then you add a risk premium at how well is this company? How strong is this company? Can this company survive throughout the next 10, 20 years? Can they follow through on projections in the next 10 to 20 years? How risky is this company being ousted? All that stuff, right? And so a good baseline for a publicly traded company, very general here, is typically about 6%. Okay, that's baseline. The higher it is, the more risky it is. The lower it is, the less risk it is. Okay, so with Facebook, it's going to be tough because it has so much competition, right? I mean, YouTube, TikTok, Snapchat, those are all competition. But they've been buying. Oh, they bought up WhatsApp, right? They bought up WhatsApp in 2018. That's probably where that money came from, or that debt. Why they lost money. Okay. I think Facebook is going to be around. They've always been adapting, and they buy up competitors. How crazy would it be if Facebook bought Spotify? I could actually see that happening. If they bought Spotify and they got in the music game, it would just turn into MySpace. If you guys remember MySpace when it had music, Facebook would turn into MySpace. Okay, so discount rate, I'm going to give them, they're kind of risky because it's social media. And social media is so dependent on trends and fads, but they are also in, don't get me wrong, don't get it wrong. Facebook is strictly an ad company. All they do is do the information and ads. But they fall under the category of social media. Gosh, I'm going to give them a 6.5%. I don't think they're that risky. But at the same time, I think inherently just being a social media platform, they're going to be a little bit more riskier than like let's say like a Walmart or Costco. All right, EBITDA multiple. EBITDA multiple, remember, is just fancy business jargon. All it is, it's profits down here after you take out all your cost of goods sold and your SG&A. So like your home office, general administrative expenses. So that's all that profit is. And so what the EBITDA multiple is after you project this out. So we always project out 5 years. It's just a standard. You don't have to do it always 5 years, but to keep it easy, I do 5 years. And then how many more years can you follow up or assume that this company will produce numbers the same as your last year? So in this case, it'd be 2024. So the standard for a publicly traded company is 8 years. Facebook, gosh, I'm just going to give them 8 because I didn't imagine Facebook can make it this far, but they're just so strong and they're getting into Instagram. They're continually evolving and they got into WhatsApp. Who else knows what else they're going to be buying and purchasing? They're going to do it in VR. I could see them extending this out to 2032. So we'll just do an 8X, kind of like an overall industry average. Okay, now let's get into pulling the super fun part here is pulling together the financials. I like to use Morningstar as always. I highly recommend it's free and it actually does a really good job. If you want to pay for the premium, you can get more data. I did not pay for the premium because I'm cheap and I can make do with the free. And all I'm doing is, you guys can't see this. It exported everything into an Excel spreadsheet, and then I'm just gonna plug and chug into my spreadsheet here. I'm gonna delete the old, go over to the balance sheet, export. Oh, UPS is here for my stuff. I'm doing this siding project and I have so much stuff just coming in and out. This is the balance sheet, right? Yeah. $2009. Go statement of cash flows. Let's do the same thing. Open. I just realized that sometimes this has an extra. See, this is why it's all messed up. Sometimes it has an extra. So this TTM, if you guys ever see this in the financials, it means trailing 12 months. So just basically 12 months. So right now it'd be from like May 2020 to May 2019. That's all that's telling you. Sometimes it's helpful, but sometimes it's not because you want to see the full year because it overlaps the last year. Okay. But let's see. All right. So why didn't it pull depreciation? It did not pull depreciation because it did not put depreciation in their income statement. So sometimes these numbers jump around depending on how the accountants like to do their books. So they didn't put depreciation in their income statement. It's definitely going to be in their statement of cash flows, which is right here. And we will pull that into... Sorry, that's the Amazon. That's my Ring, an Amazon guy. All right, so here's the depreciation amortization. Boom. So we will take that and we'll have to plug it into here. So what we need to do first is we'll need to go over to, we're going to take this over here. Boom. And then this is from AE to AK. That gave me a lot of issues last week, but let's see if I can fix it here. So we're gonna pull from, what did I say, AE to AK. And then I need to take this, copy, paste it into here. Right, I put in that cell. Yep, I did. I did it. And then we'll pull that across. And then I'll need to do this. Let me just double check. You always double check, make sure it's pulling the right cell. So it is, it's pulling right here. You see this? $1.945 billion, 1.95 right there. But I do need to do this annoying thing to make sure it's pulling from the right cells. 6, 5, 4, and 3. All right. And then you see, so all I'm doing is I'm going through this just to make sure that I'm catching all the errors. I need to fix this. Copy. Save it. So I'm going to go over here. Now I'm always looking at debt. Okay. Debt is so crucially important. I'm going to highlight it for us here. Boom. Current debt. Especially in times like right now. So this might be this is going to be an easy one. Oh, see, we talked about this, and here we go again. Okay, so this is really good. This is a great example. We talked about this last week. Remember when we were looking at debt, and I thought that they had debt, but it's not because it was actually a capital lease obligation. Capital lease obligation, for all intents and purposes, we don't want to look at as debt because capital lease obligation is like if you lease your home, right? They're leasing an office, they're leasing something, and it's not accruing interest like debt. And you don't have a big debt payment at the end of the year because when you pay a lease, let's say you do a 12-month lease and you have to pay $2,000 a month. It's not like you pay $2,000 a month and you have to pay $24,000 in month 12. With a loan, what you do is you pull out $100,000, you pay. In these cases, how business loans work is you either get amortized super high interest and it's not depreciated. It's amortized over a short time period. So $100,000 over 5 years is you have a major amount of money coming out of your pocket to pay it off. But a lot of times what companies do to increase cash flows in the beginning is they do balloon loans. And what balloon loans are is like, let's say $100,000 to keep it simple, and they do it over 5 years. And what happens is they have this $100,000 net that they need to pay, and then over 5 years they have it amortized. How come I can't pronounce it? Amortized over like say 30 years. So they only pay off a $100,000 loan. They pay $2,000 a month. That doesn't equate to $100,000 in 5 years. But what happens is they have to pay all the difference in year 5. So they'll just pay $2,000 a month every single year for 5 years. I'm not even sure that would actually cover. I'm so dumb. That would more than cover it. So that's a bad example. Let's say that they only do like $500 a month. Okay, $500 a month over 5 years. Year 5 comes, and then they have to pay the rest of their balance. Right? It balloons up. That's a balloon loan. And so you don't do that with leases. And so right here we can see long-term debt and capital lease obligation. And I'm like, what? Oh. It's all capital leases. So they leased something. And we would have to dig into this. Capital lease obligations. They lease something, but they do not have debt. So what that means for us is this will actually impact their, well, hang on. That was 9 billion, right? That was 9 billion. What was there? They had $277 million in just bank overdraft. What the heck? How do they do that? Okay, so we can see the rest of it, of the debt right here, of that 10.4 billion, or I forget what, I think it was 10 point something billion, 10.6 billion, is current portion of long term is all of this right here. And this is what we're trying to do. We're trying to paint a picture of what's going on. Sometimes it takes a little bit of digging into. So apparently 277 million was bank overdraft fees. That's insane. 277 million? Do you know how many jobs that is? Do you know what you could do with $277 million that you just paid in bank overdraft fees? That's insane. Okay. The other part was capital lease obligations current. Okay. So, whoopsie. What am I doing? I pushed the wrong button. Let me zoom back in. Sorry, guys. All right. So let's go over here and let's take out this debt here. We'll just change it to 0.277, which stands for that bank overdraft fees. That's insane, which means this makes it so easy for us. I love it when we do a company without debt. It makes it so much easier to analyze. Okay, let's go through this. Sorry, guys. You guys are asking questions. If they are alive in 10 years, dude, around 2000 years. Hey, Mark, I will do that here right after I finish this. I want to finish this. I want to finish Facebook real fast. Give me another 5 minutes. Always learning. I agree with always learning. Okay. All right. Let's do this super fast. Okay, so right here we got the free cash flows to the firm. So this is the operation. This is what we always talk about, right? The core of the business. Can they produce money as a core business? And right now, looking at Facebook, yeah, they can, and they're growing at an insane rate, right? Their free cash flows to the firm are nearly 22%. No, that's not 22%. I'm sorry. 33%. Their free cash flows to the firm are insane. And now taking out all their interest payments and their debt, which they don't have any, it basically drops straight into their bank account. Okay, so now let's look at the growth for. Let's take a look at their growth for the next couple years. So Facebook is technically considered a growth company because look at the growth rates here. We do see them tapering off. Okay, and that's probably why they've been buying so much stuff is they want to continue growing. But we do see them, they're profitable, but we can see their growth slowing down. They went from 54% to 47 to 37. So they're losing about 10% of growth each year. This year might be a little bit different, but let's follow that through. Let's say that this year, let's do 20%, and then let's taper them off to 15, and then we'll say that they grow at a 10% year over year going forward. Okay. And this doesn't have to be an exact science. We're just trying to get like a ballpark figure here. Okay, so now let's take a look at their cost of goods sold. So the cost of goods sold, it jumped up quite a bit last year. It's been basically, see, this is weird. I mean, granted, cost of goods sold is probably a lot of marketing and such for a company like Facebook. Let's do, because the last year is probably the heaviest that I would rate it. I would look into. This is without looking at their financials or their not their financials. I'm sorry, their annual report or their earnings report, and not reading into what was going on. But without looking into that, I'm going to put them at 17%, negative 17%, just to be safe. Let's take a look at their SG&A. And what we're always looking for companies is stability right here. We want to see it to either follow a trend. And you can see here, if this is a graph for their SG&A, it's kind of like all over the board. It went 22.4, down to 19.9, down to 17.8, back up to 20, and then all the way up to 28. Like, that's horrible. So we're going to have to base it off their most recent year, their previous 2 years. I'd say I'm going to go somewhere closer to the middle. I'll do negative 24%. Give them benefit of the doubt that they'll average a negative 24% the next 5 years, or actually 13 years. All right, taxes. Let's see how much they've been paying in taxes. Tax rate. They're all over the board again right there. So we're just going to use their last year of 14.6%. Again, tax rate comes down to the changes in tax laws, what they buy, what they invest in, and how good their accountants are. So it's really hard because everybody should have a baseline, all companies. And this is the thing that that causes a lot of political upheaval is tax corporations, tax companies more. There's already a baseline tax for companies. What companies are doing, how they get away with certain stuff is that they can write off certain things based on their investments or what they purchase. So for example, if they have an R&D division and I'm not sure if it's right now, but let's say like right now, the US government wants to inspire or like wants to invest in R&D, research and development in companies. They say, we'll give you XYZ tax break, or you can write off up to $10 billion in R&D. Okay, I'm going to go buy, instead of doing R&D, I'm going to go buy this company and make this company my R&D division. I'm going to write it off. That's what they do. It's not that the government isn't taxing companies. It's that companies, they pay millions, tens of millions, hundreds of millions of dollars each year to follow tax laws and to find ways of legally avoiding to pay taxes. Remember, evasion is illegal. Avoidance is totally okay, totally legal. So them by avoiding taxes is the same thing as you and I. If we don't have to pay taxes, I'm not going to pay taxes, right? I'm not going to evade them, but I'm definitely going to avoid paying taxes legally. That's what they're doing. That's why we see these ups and downs. It's not consistent. Depreciation, we'll just take the last year. We don't know what's going on. CapEx, looks like they've been spending a lot of money. We'll just continue going on. It's been dipping back down. I'm okay with 16%. Working capital, it's kind of up and down. I think 3.69 is fine. All right, that's it. Ooh, wow, look at that. So after all of that, we have them undervalued by $9. So they're trading right around fair market value. Let's jump in here and let's take a look at what these other analysts are saying. So Facebook is saying that they're valued at 215. So they're not too far off from us. So they're thinking that they are actually trading a little bit above market value. And they have a wide moat. Wide moat means like how easily can you protect your business? Okay, so a company like say a car washing company, right, has a very small moat or non-existent. Like anybody can go into car washing, but to compete with Facebook, you have to have a very wide moat. Okay. Let's do one more. Oh, did it log me out? Oh, okay, we won't do them today. I don't know my login. So that's Facebook. Let's see. Do we have any questions about that? Bill yet to be passed to the Senate are for smaller companies that are audited by small political costs. Okay, so Alibaba. So as I pull up Alibaba, and then we'll talk about Chewy super fast here. What's Alibaba's thing? Ticker symbol. Is it Baba? It's Baba, right? So my thing with Alibaba is that they are a Chinese-held company. Dude, there's a great video. I'm going to try pull it up for you guys here. It's on YouTube, and it talks about a Chinese billionaire that is basically here on asylum trying to escape the Chinese government. And he's basically exposing what's going on over there. I know it sounds like conspiracy theory. It's not. I don't think it is. China's billionaire. Is it a documentary? Here it is. Exiled Chinese billionaire. All right. Check this out. I'm putting in the live stream chat right now. If you guys want to watch it, it's 52 minutes. It's super interesting. And these are the types of videos that I watch to get more information. And I'll watch both sides. I'm not going to just watch one side. But I definitely know that if you're not unaware of what China's trying to do, they're not really good friends of the U.S. I'd say argue the world. But one thing that I do know is that it's a state-run company. It's a state-ran country, meaning that you don't really have free play, and you can't really move around easily like in the U.S. or Singapore or Hong Kong or in the European Union, where you can start a business and you can grow it to the sky, and then as long as you follow regulations and tax laws, you can do what you want to do, right? There, if you get too big or too powerful, the state or the government can step in at any time and basically say, we own this now, okay? And there's a lot of just the stories that come out of there, and it's probably not much different from the U.S. Political system in some ways, is that they will there's not a fine line between government and company, especially public company, and that makes me very nervous. That line is blended so much so where you don't even see the line anymore. And so what ends up happening is that even if the company is audited by Price and Cooper or by a U.S. firm, and they have to follow GAAP, it's that they are still backed by a country that doesn't adhere to those laws. So just for example, we actually did work. I worked for a luxury eyewear company for a while, where I did their financials, basically, the financials and operations, and we were opening up a place in China or partnering with Chinese factory to produce our glasses, because they were highly intensive. Like you had to be handcrafted basically. So we got to a point where we're buying molds to be made for like $20,000-$30,000 each, and doing all this stuff with China. And the thing that we always know that they'll do is that they'll sign a document with you saying that it's our property, like those are our designs, like whatever we give them, the molds that we sell, we buy from them, it's ours. There's this unspoken rule that we know that as soon as we sign that, we give them our proprietary design or concepts or whatever it is that it becomes free market over in China. And that is known with, it was very Nike gear, right? I don't think I have any shirts on me right now, but the Nike clothing, Callaway golf clubs, anything that is produced over there, there's a huge secondary market for those factories to sell. And it makes a lot of investors and companies nervous because they can't control that. It's a totally different country. So with that said, is that even though you sign documents, even though in the US here we do everything right and they comply, they agree to those terms, what happens when you go over to China is completely different. And we saw this very, very recently with the COVID-19 thing, where we realized the whole world, not just the US, it's not a US versus China thing. And if anything, I was in favor of China for a long time before all this stuff happened, is that no scientific community will trust Chinese numbers that they present. Because in Asian culture, I'm not sure if you guys know this, is that it's not secretive. It's just like there's this, you want to present face. You want to have honor. You want to show your strong hand. And I'm Vietnamese, and I see it in my culture. I see the resemblance in the Korean culture, the Japanese culture, and even the Chinese culture. There's just something that's, I don't know, it's part of the Asian culture. And when you admit that you messed up royally, and that it could embarrass you or embarrass your family or embarrass your government or your country, it's that you'd rather massage the numbers. And this isn't just with, I guess this is science, but my partner, Sarah, she has she's worked with Chinese scientists before, and they've caught them manipulating, changing numbers. And this isn't just one person or two people. These are, it's a cultural thing where they want to save face and they want to present the best foot forward. Now, I'm telling you this long story is because even though Alibaba is a publicly traded company, and I believe that they trade on a couple of very different stock exchanges, so obviously the US market, I believe Hong Kong, Singapore, Europe, is that they are backed by the Chinese government. And the Chinese government is so powerful that they can manipulate numbers however they want. Does that make sense? And so for me, I can't invest in something that I can't trust. I hardly trust U.S. companies to give the right numbers, because think of Enron and think about all these companies that are doing buybacks. They're doing, quote unquote, sleazy, not super good things, right? that kind of bypass the law. Oh shoot, I didn't even do that for Facebook. I totally forgot. Okay, we'll do that real quick, and then we'll jump back to Alibaba. Is that if they do that here in the U.S., what are they getting away with in China, right? But let's take a look. We'll take a look at the financials, and I'll tell you what I think if their numbers are correct. I don't know why my phone keeps going off like that. All right, balance sheet, and then we'll jump into Alibaba. Stay with me here. All right, common shares issued. Outstanding. Boom, 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 boom. Look at that. So you see right here, they bought back, how many is that? 2.8. So they bought back 60 million shares. So let's do some quick math here. In the last year, what was their price? Facebook. Full chart. Let's just take a look at what they were trading at roughly last year. Okay, so they were around, let's say 180. Okay. 60 million at 180. So they spent $10.8 billion buying back their own shares. That number is awfully close to that capital lease number. Do you guys see what I'm doing here? Oh, so this is a great example of like not listening to their earnings report, not reading through their annual report, and what they're doing is we just take a look at their numbers, do a couple of assumptions, and we just figured out that they spent $10.8 billion buying back shares last year, and that was awfully close to their capital lease. It was almost exactly to their capital lease agreement or the capital lease obligations that they had. And so you can always figure out, like a company, did they do something funky where they shifted those shares to somebody else? Did they pull out some sort of weird deal where they took out that money to buy back the shares? So that's something that we would have to dig. If I was really gung-ho on buying Facebook, I would have to dig into that to see where did that $10.8 billion come from and what was that spike up in that $9.9 billion in capital lease obligations. Interesting. But this is a great example. And like they were trading around 180 last year, right? They were trading around 180. Trading around 180, went up to 2, peaked out at 223. So yeah, look at that. Okay, this is a great example. They're basically, well, I guess not. They're basically trading sideways here from 2018, 2019. I guess they dipped down a bit, went back up. They're trading sideways. I wouldn't say this is an increase. And then once they bought back those shares, it did go back up. And it looks like they would have continued going up if this COVID-19 thing didn't hit. I don't know. Maybe I'm making up a story there, but you guys see what I'm going to get. All right, I'm sorry, Mark. You've been waiting for Baba. Let's do Alibaba here. I'm not going to do the full financial thing, but the full thing because that takes too long. But I'll take a quick look at the numbers here real fast. So they're growing at a very fast rate. My goodness, 100 million. Okay. Net income has been growing as well. Total debt. Ooh, wow. They have a bunch of debt. How much cash do they have? Okay, they've got a good amount of cash. That's a lot of debt, though. Free cash flows and operating cash flows. All right, let's go back into the balance sheet real fast. So this is 2000. Look at here. They're doing the same thing. They bought back, what is that, 25 million? And then they bought back a huge amount here. They bought back almost 50 million. And then they released 17 million. So they spent 2 years buying back a ton of shares. What are they trading at right now? 207. So they're right around. They spent probably between $5 to $10 billion buying back their own shares. Nope, they were trading cheaper there. Yeah, fundamentally though, Mark, looking at their financials, let's see what their value, what they're trading at. They're at 26 times. Yeah, looking at it, it looks like their top line growth is growing like crazy. It's insane how fast their top line growth is growing. Their operating cash flow is growing at a steady rate as well. Not quite as fast, 125 million. So they basically 50% growth there. Yeah, so you see this 50% growth for between 2018 and 2019 in revenue. It does not grow that fast here. They should have had cash flows from operating. If they were going to grow at that same pace, they should have 200 million here. So a lot of that money's their margins are getting squeezed somewhere. So they're buying, or they're selling stuff that's not as profitable. The previous year, they basically went up, let's just say 90 billion. 90 billion of that is about 60%. And they jumped up. Okay, so they jumped up. So yeah, so here's a great, they jumped up 60%. I'm doing some super rough math here, but they jumped up about 60% in revenue here in 2017, 2018. Their operating cash flows went up about 50%-ish, right? 45. No, that's about 60%. 45 billion of 80 billion is 60%, is roughly 60%. So that was hand in hand. And then all of a sudden in 2019, they jumped up 50%. Right? Did I do that right? 50%? 125. Yeah, they went up 126 billion out of 250 billion, but their cash flows only went up 25 billion. So I would dig into that. I would try to see why did their cash flows drop so significantly there. I mean, you can even see it inside their net income. 20. And then I would dig into more of like where their debt is going. Why does it keep growing? But at the end of the day, I'm not going to invest in a heavily, especially like I think they're the biggest publicly traded Chinese company. Oh, this is all in the yuan. These must not be in yuan. But yeah. Kai, if you're ever in Vegas, let's have fun. Oh. Awesome. Yeah. I'm totally down. I love pho. I'm actually going to go over to my mom's later. We're going to have some pho too. Okay. Let's take a look at Chewy super fast. Mark, I hope I answered your question. Let's take a look at Chewy. If anybody doesn't know what Chewy is, what is it? It's a pet place, right? Let me see. Hang on. I know you guys don't have this, but let's take a look at the pricing of Alibaba real fast of what Morningstar is saying they're worth. So Morningstar is saying that they're valued at 258. They're currently trading at 205. So take that with a grain of salt. I don't always, that just makes me so nervous. Is that racist of me? It's not racist, right? I'm Chinese. Or I'm not Chinese. I'm Vietnamese. I'm Asian. It just makes me so nervous that they're headquartered over there. I'd be just as nervous if that was like Moscow, Russia, right? Or like Afghanistan or something like that. Something where it's just like an unstable market and kind of like iffy government. Dude, see, I can't even. 100%. This is something that I just can't get behind. 100% of 57 analysts say that they should be buying. I don't know. I could be totally wrong. I could be wrong. Maybe you can convince me. Stewardship poor. That's because it's ran by the Chinese government. Yeah. Let me know what you do, Mark. That'd be interesting. All right, Chewy. So Chewy engages in the provision of pure play e-commerce business. It supplies pet medication, food, treats, and other pet health products and services for cats, or dogs, cats, fish, birds, small pets, horses, and reptiles. Interesting. Let's see what they have them valued at. They did not value them. That means they do not think that they are worthy of valuation. Interesting. All right, let's look at their financials super fast. And then I got to wrap this up because it's been 2 hours. All right, Chewy. Let's go valuations real fast. Right away, I know that they are not profitable because they do not have a price to earnings ratio. So we will not be able to value them the traditional way. But it doesn't mean that we can't take a look and see how strong their balance sheet is and how strong of a company they are. So they should be a growth company. So kind of like Alibaba and Facebook, they should have like insane growth year to year. And right now it looks like it's not insane, but it's decent. They went up about 50% last year, or in 2018 and 2019, and then another 45, 50% year after. Not bad. But you can see right here their net income. That's what the PE ratio is based off of. It's negative, so you can't really value them with negative. But let's see. It's not decreasing at as fast as a rate as the revenue is increasing. So that's not a great sign. Let's look at so their total debt, which could be capital lease expenses or capital lease obligations, not necessarily debt. And so they could wipe it out, but they don't have a ton of cash in the bank, but they can wipe out their debt if they need to. And then, first year, they're cash flow positive. That's a good sign. That's a very, very good sign. So Chewy is I would have to know more. I would have to listen to more. It's so hard for me to get an idea of what they're doing, but I like that they're moving in the right direction. What are they trading at? They're at last year they're at 27. They didn't even take that big of a dip this year, right? Oh wait, no, my bad. I'm looking at this wrong. This is their dip. So they started at, before pre-COVID, they peaked out at 30. They dropped down to 22. Now they're trading. Wow. They doubled in the last year. See, this is the thing that's crazy, is like this company's valuation doubled in 2 months without any financial consideration. All right, it's all speculating on people buying more pets, but nobody's actually, we don't know the numbers of people buying more pets or buying more pet food and medication and stuff. Those numbers haven't come out yet. Yet this company has, what is it? They went from, where's their, sorry, I'm just looking for their market cap right here. So they went from about $8 billion to, or $9 billion to $9 billion market cap, which is the value of the company. It's all their shares multiplied by the share price, right? To 18 billion in 2 months. Do you see how insane that is? So they didn't produce more revenue. They didn't produce more profitability, or they, from what I'm assuming, what I've seen, and they doubled in 2 months. It's insane. It's absolutely insane. Like we need to see those numbers. So it's a good play though. If you listen to their annual report and they're saying, like, hey, we're seeing huge spikes in subscriptions and we're seeing sales revenues going through the roof, but based on what they're showing here is that they haven't released numbers yet because this is the trailing 12 months and it's the exact same for 2020 here. Huh. I'll keep an eye on it. I'll have to make a note of that. I want to keep an eye on it. Okay. And the last thing was the Worthy app. Let me just take a look at what Worthy app is. Worthy app. Worthy bonds. What is this? We've sold out of our first 50 million in bonds. Now we have 50 million in new qualified 42 bonds. Dismiss. I would have to look deeper into this because bonds are... Yeah, this right here makes me... Wait, what's this? Buy bonds. Worthy loans, but money for bond sales. So bonds, I need to learn more about this because I am not sure how this works. So bonds, typically how it works is that you have, in a typical investment environment, you have investment grade companies, right? And I believe like anything below a double B, I forget the exact thing, but you fall into a junk bond category, which means like junk bond is basically a company that's not super sound, that you may not get your money back or they might go bankrupt. Double A is the best, right? So double A is like super reliable companies, and that's a normal bond. This sounds like it's kind of like Prosper. You guys remember Prosper? Where I think they're still around. You can basically lend money out to people and they have a credit score or they have a rating on Prosper. And let me see if we can look it up. Prosper. You can invest in people and let people basically borrow money. And based on their credit score, you get less or more interest. And it sounds very similar to what Worthy Bond is doing, except they're doing it for small businesses. That's not really my play. I don't like doing that. I mean, it's a great way if you want to expand your portfolio. And if you had like, $10,000, you want to put $1,000 into it, maybe it's worth it. I would have to research more into it though. I've never heard of that before. It's an interesting concept though. All right. Any more questions? Anon. For undergrad, I went to Oregon State, and then for graduate school, I went to the business school that stems from University of Texas, UT, in Austin, Texas. Are you thinking about getting your MBA? All right. Any other questions? Let me see. Let me make sure that I got through everything here. We talked about Facebook, Instagram. We talked about the compounding. Okay, last thing I'm going to talk about, and then I'll let you guys go. Let's see how many. There's still 11 of you guys in here. All right. Gosh, this is our 5th one. Thanks so much for staying with me, you guys. 5th live stream. I'm going to keep on trying to do this, okay? The last thing I want to talk about is a little bit more about, obviously we've gone through the numbers, we've gone through what my thoughts are, got a couple of updates about Airbnb, no updates about stimulus. I want you guys to remember that, or think about, I don't want you guys to ever think that I don't want to preach or like stand up on a soapbox, but I think that this is really important when it comes to change and embracing change. And real quick is that as investors, and we start moving closer and closer to this depression. And even if we're in a bull market and everything's great and you've got your job, it's really important as somebody who's trying to further themselves financially, become better individuals, is embracing change. And I think that people that have the toughest time, whether it's fiscally, it's mentally, it's emotionally, intellectually, whatever it is, it's the folks that resist change, or even worse, they can't adapt to change. And I think the best thing that's ever happened to me is when my mentor, or when I started working on not just adapting to change, but embracing change, is because knowing that the market and things, myself, everything is ultimately going to change. And I know it sounds so cheesy and it sounds so Tony Robbins-y, but it's something that I really do stand behind. And I believe it's a part of this competent, effective mindset that allows you to move forward in life with whatever it is that you want. And I think it's really important to define what it is that you want, and understanding that there's certain changes that will get in the way of it. And you can look at it as an obstacle, or you can look at it as an opportunity. And I think the vast majority of Americans, and I don't think anybody inside this room, the 11 or 12 of you that are still in here, would ever be categorized inside that group, But as people who see this as a huge obstacle, you could see it as an obstacle to overcome, or you can see it as an opportunity. And I see that in everything. But I think the important thing is first to define is what it is that you want. What kind of life do you want to live? How much money does that life require? And I'm speaking to you as somebody who could have, in general terms, could have a good career with a high six figure paycheck. But it's not something that I want. I'd rather make much less money, but live a completely free life. And that's why I won't have the millions and millions, and I won't be having the yachts, the cars, or the multiple vacation homes or stuff like that. It's not me, right? I'm just a surfer dude. But I have friends that make $500,000, $600,000, $700,000, millions of dollars a year. They have their Rolexes, they have their suits, they have their nice ties, their nice shirts, their trips to Italy, and all that stuff. But what I'm getting at too is that those types of folks that latch on or marry on to certain ideas or concepts, businesses, they get rocked the hardest when something like this hits, whether it's a pandemic, it's a depression, it's a recession, it's getting laid off, it's changes in your portfolio where you see your portfolio take a 40, 50% hit. And when you can embrace that and understand that that's a part of life, and you start looking at the solutions around it rather than the problems or the issues with it, it creates not just a solution focused mindset, but it allows you to move more closer or move towards what it is that you want. I'm not sure I'm making sense right now, but I think hopefully I am to the folks that are still in this room, is that remember, things start first with discipline and getting those easy wins first in not just your day, but inside your life, right? Whether you create a budget for your groceries, budget for eating out, how often you work out, that type of thing, is those little wins and the ability to create a standard for yourself, teamed up with the ability to accept and embrace change, will give you the formula of achieving what you want. And I know a lot of the things that we talk about on my channel is about finances and it's money driven, but I wish I could talk more about it, but I don't think there's a large audience for it, or the audience that needs it doesn't know that they need it. Is a lot of it is behind what's in here, which sounds so cheesy too, but you guys get what I'm trying to say. And I think a lot of that comes, I know it for me, is it comes from a mindset of discipline, constantly learning how to learn, and embracing change. And there's a couple of other things in there too that's important that we can talk about another time. But today, I want you to focus on what changes do you see happening in your life, and how can you embrace it instead of fighting against it? And then potentially, what are the solutions and opportunities that you see? And I know it's different for everybody. For all intents and purposes, I'm not married. I don't have kids. And so I don't have kids to have to look after. I don't have a wife that her and I we have to find a job, or because we got laid off, we have to worry about money. And I know that we're in different situations where some of us may have been laid off. But whatever your situation is, there is an optimal scenario for you. Okay? It may not be the best scenario, the scenario that you want, but there is an optimal. And I'd say my suggestion for folks, and this is for me too, is that whatever your optimal scenario is, do everything that you can to get to that optimal scenario in your life. So whether you have a job or you don't have a job, you work from home, you have 2 kids, you just have a dog, whatever it is, figure that out and start moving towards it. All right, off my soapbox, no more Tony Robbins, but I think that's important because the messages that I've been getting from a lot of folks, and it's kind of, it hits me in the feels. It's important that people are struggling right now, and I think the best way, outside of giving you $10,000 here, $1,000 there to help kind of put a Band-Aid over your wound, I think the best thing is for us to pull ourselves out of it. Anyways, with that, I love you all. You guys are awesome. Let's see if there's any questions here. You're welcome, Mark. I hope that helped. Let me know if you decide to invest in it, in Alibaba. Ooh, this is the new name. I'm so sorry in advance. Olad Kun Akundeo. Cool name. Good point regardless of profession or interest. Programmers know it, athletes know it, investors know it. Embracing change is a skill in itself. Absolutely. Always learning. Man, you guys were in here for a long time. Did you guys jump in and jump back out, or jump out and then jump back in? Either way, I gotta go. I'm gonna go over to my mom's. We're gonna eat some good Vietnamese food. It's Saturday. I thought it was gonna be raining, so I couldn't work, but today would have been a great day to work because it's not super hot and sunny. But thank you so much. I'll see you guys next weekend. We'll see. Whoops, sorry. I'll see. I might do it Saturday or Sunday again. Follow me on Instagram. I'll let you guys know here on YouTube as well. But thanks so much. Love you all. Peace out.